Hello folks, Steve Lenz here with Discover Options here at Option View Systems. Welcome to this edition of 3 market timing reports for the SPX for advanced options traders. This will be for Friday, September 28th, getting ready for Monday, October 1st, 2018. Presented material is for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started with the reports, you should know that Discover Options has a fantastic mentoring program, mini courses as well. All of our courses involve a one-on-one session with you and a professional option trading mentor that can make sure you have the material down, and we can take you anywhere from beginner or intermediate up to an advanced level in about as fast of time as possible. Check us out. Go to discoveroptions.com and you can look at all our curriculum. And we've been doing this for about 12 years now. We were one of the first on the scene in this to fill a need out there for the options trading market. All 3 timing reports are pertaining to the current market condition. We define the current market condition in 3 different ways: price action, trend, and the stochastic situation. So you can see on Thursday we had an inside bar, and Friday we had a downswing bar, where you had a lower high and a lower low. Okay, so price action wise, the fact we have an inside bar on Thursday means that we're not going to have a whole lot of samples going back to Jan of 2000 like we do. And so let's look. Besides price action, we see that the price action is occurring above the 50-day simple moving average, and with the stochastic between 40 and 80 on a downtrend below its 3-day simple moving average, the 15-3 stochastic. So when you combine that definition of where the stochastic is in a downtrend between 40 and 80, we're in a long-term uptrend above our 50 simple moving average, and we have an inside bar followed by a downswing bar. That market condition, defined that way, has occurred about 38 times since January of 2000. That's not very often. Nevertheless, we are going to report on the statistics behind those 38 occurrences because it could lend itself to an edge looking at what happened in the past there. So we go first to the Condor and butterfly timing report for those of you that like to sell options premium in a more of a market neutral approach. So since Jan of 2000, we've had roughly 4,726 closes of the S&P 500. Now, of those, 65.1% have been favorable bars for selling option premium, where the actual 21-bar movement of the index, the subsequent movement, was less than what was being implied by the SIBO's skew-adjusted VIX. Okay? One more time. Of those 4,700 plus closes, going back to January of 2000, 65.1% have been favorable bars for doing butters and condors. Why? Because the actual movement that occurred in the market was less than what was being implied. The option premium was implying a greater amount than greater volatility than what actually came to pass. Okay, 65% of the time. Now, also, during that time, as I mentioned, our market condition has occurred 38 times. Now, of those 38 occurrences, 71% of those have been similarly favorable for option premium selling. 71 is a higher number than the baseline of 65.1. So we have then a theoretical option premium selling edge of 5.9%. Okay, so statistically, it's more likely than usual that this current market condition will end up being a favorable one for market neutral option premium selling, like using butters and condors. Okay, so there's that report there. The bull put spread timing report. This presupposes that we're going to sell option premium in the form of out of the money puts, about a standard deviation out of the money, 21 bars or 30 calendar days out in time. And if the market moves down and hits our short strike any time before it expires, well, we would take the loss and run away and take our loss there. Okay, so but if it doesn't hit that short strike, well, then at expiration we would make the entire credit from the credit spread. All right, so with that in mind, here we go with the report. Of those 4,726 daily closes of the SPX, 83.2% of the time, all right, we've had favorable bars for selling put premium like this, where the actual 21 bar downside movement, the downside movement now, not general movement, but only the downside movement, 83.2% of the time, the downside movement was less than what the SIBO's skew-adjusted VIX was implying to the downside. Okay, so we use the skew, SKEW, is something that the SIBO publishes to help us ascertain from the VIX the upside implied VIX and the downside implied VIX. And so 83.2% of the time, the market does not drop as much as what the SIBO skew-adjusted downside VIX is implying. So that's the benchmark, 83.2. Now, of those 38 occurrences we have of this market condition, 89.4% of those were similarly favorable for selling puts. Okay, so we have an edge of roughly 6.2%. Statistically, it's more likely than usual that the current market condition will end up being a favorable one for selling out of the money put premium. Okay, great. Finally, let's go to the market likelihood report. This answers the question based upon the past occurrences, those 38 past occurrences of our current market condition. What is the market likely to do based upon what happened in the past? And we judge, the behavior of the past in terms of two aspects: rates of change in 3 different time frames, 1 and 2 and 3 weeks, and then also the realized volatility level. So let's first look at rate of change. And we do that right up here. We're going to go right up here. And we can see that out of the 4,730, in this case, occurrences of the SPX, all right, oh, good grief, what just happened? No, we don't want to do that. Here, let's get rid of that. There we go. I blew it up. Okay, we can see that of those 4,730 occurrences, on average, the market has gone up over a 5-day period. You can take any close, go forward 5 closes, look at the 5-day, how much the market moved 5 days later. You have an average increase of about 0.11, about 11.11 of a percent. Just a little bit more than 0.1%. Okay, so we know that since Jan of 2000, the market's been on a long-term bullish run. We've certainly had some pullbacks, some bearish seasons in there, but in the long run, the market's gone up quite a bit. And on average, every 5 days, it goes up more than 0.1% every week. On average, every 2 weeks, it goes up 0.2 or about 0.5%. And every 3 weeks, it goes up just shy of 0.33% to the upside. Okay, that's the benchmark here, the benchmark rate of change. When we go look at our 38 occurrences of our market condition that we have in the past occurring, we can see that of those 38 occurrences, the average 1 week rate of change is about 0.44%, just something just under 0.5% to the upside. The 2 week rate of change, on average, is 1% to the upside, 1.04. The 3 week average rate of change is about 1.37% to the upside. Very bullish. Very bullish. This is far more bullish than the benchmark of just 0.1%. So how much is that difference? I mean, if we got 0.11 to the upside as the benchmark and 0.44 from our sampling here, that's a difference of 0.33. When we divide 0.33 by the standard deviation, we get what's called a z-score of 0.41. So that's telling us the significance of this difference here. And 0.41, it means that it's about 40% of one standard deviation to the upside. Not quite half a standard deviation to the upside. So a definite bullish bias to the point where it's just under a half a standard deviation to the upside. The 2-week change is almost 3/4 of a standard deviation to the upside, as is the 3-week rate of change difference here. So very bullish. But, anywhere from just under half a standard deviation to 3/4 of a standard deviation to the upside. Now we can take that 38 and divide it by those times where the market goes above Friday's high and those times where the market went below Friday's low. That to the upside occurred 15 times, to the downside occurred 16 times, and I think the other 7 times it probably was an inside bar or an outside bar and did both. I think it would probably be inside bars again in that case, because we're missing about 7 there. You can see here similarly the z-scores between half a standard deviation and a full standard deviation to the upside. On the others, you have about pretty much flat z-score and then almost a full standard deviation on the 2 and 3 weeks. So generally, you have a bullish bias here. So that's the rate of change, showing that we have a bullish bias based upon the history of this market condition. Let's go to realized volatility now. Over the course of the market's history since Jan of 2000, the market averages roughly about 15.5 to 16% annualized volatility on the 1, 2, and 3 week basis. That's the realized volatility level generally of the market. Okay, now when we come to our market condition, it's roughly around 11.5 to 12. Much less volatile. And that corresponds down here to what the VIX is at. Look at that, at about 12.12%. So it's right in the ballpark. The 9-day VIX at 11.17. This is a bullish term structure where the short-term VIX is lower than the longer-term 30-day VIX. So a bullish bias there. Okay? So with that said, finally, I just want to thank you for joining us. I'm Steve Lentz with Discover Options. If you have any questions, go check out our curriculum. Give us a call. Go to our website. We'd love to hear from you and help you attain your trading goals. Thanks so much. Bye-bye.